consequences of oil at $55 a barrel as opposed to where we saw it during the summer really can be looked at, I think, from a couple of different standpoints. The first is in terms of the implications for policy and how the central banks are attempting to govern their way through the current economic crisis, and that is to essentially to flood the system with liquidity. That wouldn't have been possible had oil been still trading at $100 or $120 or $130 a barrel because of the inflation concerns and inflation expectations that higher commodity prices had through the first part of 2008. So the fact that oil has fallen has really put another arrow in the quiver, if you will, of central bankers in terms of trying to deal with the current chaos in the financial markets. From a demand perspective, I think there's both pros and cons to a cheaper price of oil. Obviously more demand at cheaper prices, but the potential and probably the reality of far less money directed into exploration for new energy fields and for investment in alternative energy. So the long-range consequences of a cheaper price of oil could, in fact, surprisingly enough, be higher prices in the future. One of the reasons I think that the price of oil is falling so precipitously at this point is simply because of questions about future demand, and that demand is based on the notion of dramatically slowing global economic growth. So right now I would say that the price of oil is trying to find an equilibrium between the long-term outlook that most people have, and that is that oil is going to go higher and significantly higher, and the current day reality of the supply and demand relationship. Fascinating to note that the actual cost of producing oil from most conventional sources is significantly cheaper than the price that it's currently trading at. So when you think about it from a shorter term perspective, and yes, absolutely there will be less demand because of the global economic situation, it's not so hard to understand how the price of oil continues to drop. The inherent cyclicality of oil prices is what should keep investors from devoting too high a percentage of their portfolio to this asset class. While it is absolutely easy to draw a correlation between cheaper prices now and higher prices in the future, it's a very long-term development, really, from a portfolio structure, and there's absolutely nothing to say that it should be reflected in the near term. What investors can look for is integrated oil companies that have the ability to perform well even during a cyclical downturn in the commodity, which is what we're experiencing now, and still be poised to benefit when that trend turns.